You know, in the world of finance, you've got the household names everyone talks about. And then you have the titans, the ones quietly shaping the entire economy from behind the scenes. Well, today, we're pulling back the curtain on one of the biggest, ARCC Capital Corporation. Let's get into it.
So what's with this number, 9.4%? Yeah, it's a massive dividend yield. But really, it's our doorway into a multi-trillion-dollar industry that is fundamentally changing how businesses get the money they need to grow. The big question is, how can a company this huge offer a return like that? And maybe more importantly, is it actually safe? That's what we're here to figure out.
All right, here's the game plan. First, we're going to get the lay of the land. What is private credit and where does Ares fit in? Then, we'll unpack their secret sauce, their specific business model. We'll see how it held up under some crazy economic pressure. Then we'll dive into the hard numbers. And finally, we'll deliver the final verdict on this financial giant.
For decades, the story was simple. If you were a medium-sized company and you needed a loan, you went to a bank. That's it. But that world is changing, and it's changing fast. You see, after the '08 crisis, new regulations made it harder for banks to make those kinds of loans, and that created a huge gap. Stepping right into that void was a new industry, private credit. And standing right at the top of this new food chain is ARCC Capital, or ARCC.
And listen, this isn't some flash-in-the-pan startup. ARCC has been a public company for over 20 years. Think about everything that's happened in that time. The great financial crisis, the pandemic, you name it. To deliver a 13% annualized return through all that volatility, that's not just impressive, it proves they are absolutely battle-tested. And that really gets to the heart of it. What used to be this kind of niche, alternative strategy for sophisticated investors has blown up to become a fundamental pillar of our financial system. And with a portfolio that's now north of $30 billion, ARCC isn't just another player in the game. No, they are the game. They're the benchmark that everyone else measures themselves against.
Okay, so how did they get so dominant? It's not just about being big, it's about being incredibly smart with that size. They have a strategy that builds this almost unbeatable competitive advantage or moat around their business.
But first, a real quick definition so we're all on the same page. ARCC is what's called a business development company, or BDC. The easiest way to think about it is like this. It's a company you can buy stock in, just like Apple or Google, but its business is lending money to hundreds of private middle-market companies. It basically gives everyday investors like us a way to get into the private markets.
Now this right here is ARCC's secret weapon. It's a subsidiary they own called Ivy Hill, and it is a brilliant system. Okay, so ARCC finds a good company to lend to, but maybe the interest rate is a little lower than they'd like for their main portfolio. Instead of just passing on the deal, they sell that loan to their own subsidiary, Ivy Hill. Ivy Hill then manages it, collects fees, and, here's the kicker, pays a dividend right back to the parent company, ARCC. It's a genius recycling system for deals that creates this powerful second income stream.
And this quote just sums it all up perfectly. Because they're the biggest, the oldest, and the most trusted lender out there, they get the first call, every time. This means they get to see pretty much every good deal on the market, which lets them cherry-pick the absolute safest and most profitable opportunities for themselves, leaving the leftovers for everybody else.
Of course, a great business model sounds good on paper, but the real question is, how does it hold up when things get ugly? And boy, the last 5 years have been a perfect trial by fire. We've had a global pandemic, historic inflation, and the fastest rate hikes in 40 years. So how did Ares do?
You know, this timeline is just fascinating. Back in 2020, during the pandemic, they played defense. They hoarded cash and just focused on making sure their existing companies survived. But then came 2022, which analysts are calling the golden age. See, almost all of ARCC's loans have floating interest rates. So when the Fed started hiking rates like crazy, ARCC's income just exploded. It was like a gusher of profits. And now they're pivoting again, trying to lock in great deals before rates start to come down. It just shows an incredible ability to not just survive, but actually thrive in totally different environments.
All right, that's enough of the big picture strategy. Let's roll up our sleeves and get under the hood. It's time to look at the hard numbers and see what the data really tells us about the health and safety of this company. This is where the story meets the facts.
So the very first thing you want to look at is what they actually own. And what this chart shows us is a deeply defensive portfolio. Look at that. Over 60% is in what's called first and second lien senior secured loans. All that means is that if one of their borrowers gets into trouble, Ares is at the very front of the line to get their money back. That is a massive layer of safety baked right into the portfolio.
And you can see that safety show up right here. This chart shows the percentage of their loans that are at risk of default, what they call the non-accrual rate.
Now, during the Great Financial Crisis, this number shot up to around 5% for the industry. But today, even with interest rates at multi-decade highs putting pressure on everyone, ARCC's rate is a tiny 1.8%. That is just incredibly low, and it speaks volumes about the quality of the businesses they lend to.
Okay, now for what might be my favorite number on the page, $1.26 per share. This is something called spillover income. Just think of it as a giant rainy day fund. It's profits they've already earned but haven't paid out to shareholders yet. And get this, it's enough cash to cover their entire dividend for almost 3 full quarters, even if their profits went to zero tomorrow. For anyone who cares about income, that is a gigantic safety buffer.
And the market sees this quality. It really does. When you put ARCC next to a competitor like FSK, the story becomes crystal clear. Yeah, FSK is offering a monster 16% yield, but look, it trades at a big discount to its net asset value. That means the market thinks its assets are worth less than what they say on the books. ARCC, on the other hand, trades at a premium. Investors are willing to pay a little more than its assets are worth, and they're willing to accept a lower 9.4% yield in exchange for that stability and best-in-class management. It's the classic definition of a quality premium.
So, we've looked at the strategy, we've seen how they handle a crisis, and we've dug through the numbers. Now it's time to put it all together. What are the key takeaways? What are the biggest risks to watch out for? And what does the future hold for this titan?
Beyond the balance sheet, ARCC has these incredibly powerful strengths that you can't really put a number on. They have that incumbency effect, relationships that go back 20 years, which means they get that first call. Their portfolio is so massive, over 500 companies, that it gives them a live, real-time data feed on the health of the entire U.S. middle market economy. And because they're so big and trusted, they can borrow money more cheaply than anyone else. It's a deep, sustainable moat.
But look, it's not all sunshine and rainbows. The single biggest risk facing not just ARCC, but the entire private credit industry is actually its own success. There is so much money flooding into this space right now, we're talking from pension funds, sovereign wealth funds, you name it, that there's a real danger of way too much capital chasing way too few good deals. And that, of course, could drive down returns for everybody.
Now, Ares is acutely aware of this risk. So what's the response? They're basically moving up market. They're using their massive scale to focus on huge, complex, jumbo loans, the kinds of deals that only a tiny handful of players in the entire world can even think about financing. It's a smart way to insulate themselves from the dogfight happening at the lower end of the market.
So when you weigh all the evidence, the final verdict from the source material is pretty clear. Ares Capital is viewed as a core holding, especially for an income-focused portfolio. The whole idea here isn't about hitting a home run on growth, it's about getting a high, safe, and reliable dividend, backed by a stable book value and what is pretty much universally considered the best management team in the business.
And that really leaves us with one last big question to chew on. We've seen this industry go from a niche corner of finance to a central pillar of the whole system. As that trend continues, are these titans of private credit, like Ares, on their way to becoming the new, powerful banks of the next decade, but without all the same rules and regulations? That's the multi-trillion-dollar question to watch in the years ahead.